I'm going to talk to you about how the FX market worked, what the fixes were, how they were set, and how Barclays traders attempted to manipulate the FX fixes. I will also talk to you about stop-loss orders and how Barclays traders attempted to manipulate spot FX market rates to trigger those orders. These slides need to be viewed in context. We have imposed a penalty on Barclays for systems and controls failures. Those failures made the misconduct by traders possible. As you can see on this slide, the FX market is absolutely massive. The daily average volume turnover of the global FX market was over $5 trillion in April 2013, according to the Bank for International Settlements 2013 survey. And to put this in perspective, you can see on the right how the size of this market compares with a few other key markets on a daily basis. The global bond market with $272 billion, the global equities market with $216 billion, and the New York Stock Exchange with $49 billion. The word fix is market speak for an FX benchmark. In this case, we are talking about two of the most widely referenced fixes, the 4 p.m. WM Reuters fix, or WMR, and the 1:15 p.m. ECB fix, which are fixed in two different ways. WMR fixes happen throughout the day, but the most widely used is the 4 p.m. fix. During the period we are talking about, the 4 p.m. WMR fix was calculated by reference to trading activity during a 1-minute window, or fix period, 30 seconds before and 30 seconds after 4 p.m. The 4 p.m. WMR fix rates are then published shortly thereafter. This diagram gives a hypothetical example of what the WMR fix might look like, where the purple shaded area represents the 1-minute fix period and the blue line represents the trading. The ECB fix is different because it is a snapshot of the market at a moment in time, which is 1:15 p.m. And this is what the diagram shows, that instead of having a fixed period, we have a single point in time. Why do people want to trade at the fixed price? The Financial Stability Board's September 2014 report on FX benchmarks said that asset and other money managers want to ensure that their FX trades are executed at the same price as the fix. That eliminates any tracking error. Prior to a fix, clients often place orders with a firm to buy or sell a specified volume of a currency pair at the fixed rate. Obviously, at that time, the future fixed rate is unknown. By agreeing to transact with clients at a fixed rate that is yet to be determined, the firm is exposed to rate movements at the fix. So as you can see here, the risk passes to the firm. A firm will typically buy or sell currency in order to manage this risk, for example by trading in the market or netting off, for example where a firm has a buying interest for the fix and trades with a market participant which has a selling interest for the fix. So in this example, the client wants to buy a currency pair and the firm is agreeing to sell that quantity of the currency pair to the client at the fixed rate. What this means in practice is that the firm with this buy order will make a profit if the average rate at which it buys the currency in the market is lower than the fixed rate at which it sells to its clients. There is nothing wrong with a firm which is legitimately managing its risk making a profit through trading at the fix. One of the issues in this case is the lack of control over the chat rooms used by traders. Many firms have now imposed restrictions or outright bans on the use of chat rooms in certain circumstances. In October 2012, Barclays issued instructions to its global FX traders to cease using persistent multi-bank chat rooms. Traders use chat rooms to share information about fixed orders, to determine their trading strategies, and to attempt to manipulate the fix. Certain groups of traders describe themselves or others using phrases such as the players and the three musketeers, and in one instance, a trader commented to others in a chat that we all die together. The Barclays final notice includes a worked trading example of behaviour around the fix which was able to happen because of Barclays' inadequate controls over its spot FX voice trading business. We have prepared some slides which demonstrate this visually using the material from the notice, which we think helps make it clearer what was going on. The example occurred on one day during the relevant period when Barclays attempted to manipulate the WMR fix in a particular currency pair. On this day, Barclays had net buy orders at the fix, which meant that it would benefit if it was able to move the WMR fix rate upwards. Remember that the WMR fix was set based on trading during a 1-minute fix window. Because Barclays is a buyer, it would benefit if it could move the fix rate up. Let's look at what the traders were saying to each other ahead of the fix. In the late morning, the firms involved were disclosing their order flows and trading strategies using language such as, "Come on, I liking this, I just asking my guy if I got anything yet, I fancy it today," and Barclays commented that if they were all buying, I would fancy it too, ha ha. Let's watch what happened next. Barclays needs to buy $200 million for the fix. Firm A needs to buy $150 million and Firm B $70 million. Firm B is also aware of another $200 million buy fix orders. This increases to $220 million. Firm B says, "Boys, so we are locked." Firm B also disclosed that an interdealer broker was looking to trade an additional $135 million at the WMR fix and asked whether they wanted to trade. "Wants to do another 135, we want any of it." Barclays now has orders to buy $400 million at the fix and encourages Firm B to trade with the interdealer broker. You do that. Firm B does so and now needs to buy $360 million. Okay, 360. This is an example of Firm B building. Building with third parties outside the chat room effectively increases the volume of orders held by the firms represented in the chat room in the desired direction. The more you have to trade in the fix window, the greater your potential influence on the fix. Firm A asks, "So how much we got to buy in total?" Barclays says, "400 me," and Firm A says, 200. Firm B then says, "If we get this 75 bid, which means a fix rate of 75, I will love you both forever." At this point, the bid in the market was 57. Firm D now asks if Barclays was the other way, that is, buying currency in the market, as it will be selling $125 million. Barclays needs to buy $430 million and would prefer to trade this amount at the fix, rather than match that $125 million that Firm D wanted to trade, but would match with Firm D if it was unable to trade via an interdealer broker. Would rather do the 430, but will match with you if you can't offload in broker. Firm D's position has now changed, and it needs to buy $80 million. Complete flip now, I lose 80 odd, joke. Barclays responded, "Cool, suits." Firm D's position is now aligned with Barclays. Remember, because Barclays is a buyer, it would benefit if it could move the fix rate up. The chances of success would be improved if Barclays and the other firms shared information. Since Barclays and Firm A each need to buy dollars at the fix, each will profit to the extent that the fix rate at which it sells dollars is higher than the average rate at which it buys dollars in the market. This graph is a hypothetical example demonstrating this. The blue line shows where the market is trading. The green dotted line shows the average price at which Barclays bought currency, and the dotted purple line is the fix price. The gap between the fixed price and Barclays' average price represents Barclays' profit. Barclays has buy orders from clients and another Barclays desk of $306 million. In the period leading up to the fix, Barclays increased or built the volume of dollars that it would buy at the fix through a series of trades conducted with other market participants. This trading increased its volume to $505 million. well above that necessary for risk management. Remember, the more you have to trade in the fix window, the greater your potential influence on the fix. In the last 2.5 minutes, immediately before the fix window, Barclays bought a total of $165 million. These early trades were designed to take advantage of the expected upwards movement in the fix rate following the discussions within the chat rooms. It accounted for 23% of all purchases in the currency pair on the EBS platform during this period. Firms A and B also bought currency at this time, and the aggregated purchases of the three firms accounted for 44% of the total purchases on EBS, as you can see in this diagram. The rate steadily increased from 57 to 72 at this time. During the 60-second fix window, Barclays bought $254 million, which accounted for more than 18% of all the purchases in the currency pair on EBS. Barclays and firms A and B together accounted for 32% of the purchases in the currency pair on the EBS platform during the fix window. During this period, the rate rose from 72 to 80 before finishing at 77. Subsequently, WM Reuters published the 4 p.m. fix rate for the currency pair at 77. Let's see what they had to say after the fix. Firm B congratulated the others. "Boys, well done, top work." Barclays added, "Well, I bought the ugliest 300 there I could, ha ha." Firm A said to Firm B, "You ask for 75, that is a fix rate of 75. Remember, the actual fix rate was 77. Barclays added, "We delivered, but I don't want a kiss from you, I just take a beer." Later, Firm B stated, "Thanks for the encouragement with the building, making me do extra 135, which is a reference to the extra $135 million Barclays had encouraged Firm B to take from an interdealer broker. Barclays responded, "Suited us all, didn't it?" Barclays trading in this example generated a profit of $286,000. I'm now going to talk to you about stop-loss orders. Stop-loss orders are placed by clients to help manage their risks arising from movements in the spot FX market. By accepting these orders, firms agree to transact with the client at or around a specified rate if the currency trades at that rate in the market. A stop-loss order is said to be triggered when the currency trades at that specified rate in the market. At this point, the firm will transact with the client. This graph shows a hypothetical example of a stop-loss order that has been placed by a client that has sold currency in the market. To manage the risk associated with this position, the client has placed a stop-loss order to buy back that currency if the market trades at a specified rate above the current market rate. This specified rate is shown on the graph as the stop-loss level. Because the client has sold currency, it will suffer a loss if the market rate increases above the level at which it sold. The purpose of the stop-loss order is to limit this loss by purchasing back that currency if the market rises. When the market trades at the stop-loss level, the stop-loss order is triggered and the client will then buy currency from the firm to prevent further loss. By agreeing to transact with a client at or around the stop-loss level, a firm is exposed to movements in the spot FX rate. Firms can legitimately manage the risk arising from a client's stop-loss order and make a profit or a loss. However, there is a potential incentive for a firm to manipulate the spot FX rate in order to execute the stop-loss order. For example, a firm with a client stop-loss order to buy a particular currency might deliberately trade in a manner designed to manipulate the spot FX rate higher in order to trigger the client's order at the specified rate, which could result in the firm making a profit. The Barclays final notice includes a worked trading example of an attempt by Barclays to trigger a client stop-loss order, which was able to happen because of Barclays' inadequate controls over its spot FX voice trading business. Let's watch what happened. Firm X asked the chat room participants, "You got stops?" to inquire if they have any stop-loss orders. Barclays responds by disclosing that it has a stop-loss order to buy 80 quid, or £80 million, at a level of 95. As we will see, Barclays then tried on 3 occasions in the course of an hour to manipulate the spot FX rate to trigger this order, during which time it indicated that it was managing the order as if the level was 97. Barclays then notes that it is primed like a coiled cobra, concentrating so hard, made of wax, haven't even blinked. When the market rate increases to 84, Firm X comments that it is higher, isn't it? Barclays responds, "Watch out, will be soon." As part of its first attempt, Barclays then purchased £66 million at rates between 78 and 95. Immediately thereafter, Barclays placed an order to buy £5 million up to a rate of 97. This order results in Barclays buying £2 million at 95 and £3 million at 96, before the rate falls back lower. At approximately 10:49, Firm X comments, "Hope that was an OT." That is, a one-touch stop-loss order, which would have enabled Barclays to trigger the stop-loss order when the market traded at a level of 95. Firm Y indicates that it was just about to say that. However, Barclays is managing the order as if the level was 97, so the order has not been triggered. Barclays responded to firms X and Y by saying, long sum here." This indicated that having bought sterling, Barclays had been unable to execute the stop-loss order and was left with a long position. At approximately 10:58, as a second attempt, Barclays placed an order to buy £10 million up to a rate of 97. This order resulted in Barclays buying £10 million at 95, following which the rate fell to 85, and Barclays noted, "By approximately 11:09, the rate had fallen to 78, by which time Barclays had reduced its long position by selling sterling and noted it was dead." Barclays also confirmed to the other firms that the stop-loss order would not be triggered until the rate reached 97 and that it couldn't get the 97 print despite trying super hard. The third and final attempt occurred at approximately 11:37. At this time, the market was trading at 94, and Firm X commented, "Attempt number 3. Barclays then placed an order to buy £2 million up to a rate of 97. As a result of this order, Barclays bought £1 million at 96 and at 97. The purchase at 97 enabled Barclays to execute the stop-loss order, and it sold £77 million to the client at a rate of 96.5. Barclays then confirmed this to the other firms, saying done. Following the triggering of the stop-loss order, Firm X commented ironically that Barclays would have one happy client. Barclays responded, "He should be, as he wants minimal protection and really could have been done with 96 print, but we held him in," which is a reference to Barclays not executing the stop-loss order when the market traded at 96. The other firms responded to Barclays by noting that instead of holding the client in, Barclays attempted to trigger the stop-loss order. Firm Y responded to Barclays, "Ha ha ha, hardly. That's not holding him in. Good work though." Firm X concurred. "Held him in, with a lot of cursing. You tried to carve him and eventually succeeded." Firm Z stated that Barclays' comment about holding the client in might have to go in the quote book. Barclays responded, he. Barclays executed the stop-loss order by selling £77 million to the client at a rate of 96.5. Although Barclays executed the stop loss, it had also made a number of sales in the market at lower prices as it unwound its long position. As a consequence, the average price at which it bought sterling was higher than the rate at which it sold, and it incurred a loss equivalent to $63,845.